Hello and welcome. Today, we're setting off on a kind of decision journey. It's the exact same one an accountant takes to get a handle on things like cash, stocks, and bonds. It can seem complex, but we're going to break it down. Okay, let's get into it. So, here's our roadmap for the trip. We're going to start with the basics. What are these things? Then we'll figure out how to classify them, choose a path for value in them, look at a really clever way they're used to manage risk, and finally, we'll get to the big question. Why do these rules even matter? First stop on the journey. What exactly are we talking about here? I mean, before you can account for something, you have to know what it is, right? So think about this for a second. You've got cash in the bank, shares in a company, and a corporate bond. They seem like completely different animals, but from an accounting point of view, they share a really important fundamental identity. Any guesses? Well, the answer is they are all what accountants call financial instruments. Now, this formal definition here, it comes straight from the rulebook. And the key idea is right there in the first few words. It's a contract that creates a two-sided financial relationship. And here's where you really see those two sides of the coin. A financial asset gives one company a right to receive cash. At the same time, a financial liability creates an obligation for another company to deliver that cash. See? One person's asset is always another person's liability. And this idea covers a huge range of things you'd find on any company's books. We're talking everything from something as simple as cash in a bank account all the way to more complex things like options and foreign currency swaps. Okay, so once we've identified that we're dealing with a financial instrument, we hit our first major fork in the road. We have to make a big decision. Is this thing debt or is it equity? And here is the absolute key question, the one that decides everything. Accountants look past the legal name of the instrument and focus on its economic reality. The question is there a contractual obligation to pay cash back? If the answer is yes, like with a bond, it's debt. If there's no such obligation, like with a regular stock, then it's equity. Simple as that. And trust me, this is not just some academic exercise. This decision matters a lot. Why? Because it flows directly to the bottom line. Payments on debt are an interest expense, and that reduces a company's profit. But payments to equity holders, dividends, don't. That is a massive difference that can affect everything from how investors see the company to how much executives get in their bonuses. All right, let's get on the main highway of our journey. Now that we've classified our instrument, we have to decide how we're going to measure its value over its entire life. And this, my friends, is where things get really interesting. I know, this decision tree looks a little intimidating at first glance, but just think of it as our map. An accountant starts right at the top and asks a series of simple questions. Things like, what's the business model here? Or is it an equity instrument? And depending on the yes or no answers, they follow a path that leads to one of three main destinations we're about to check out. The first path is called amortized cost, and it's probably the most straightforward. This is the one you take when your company's business model is super simple. You buy something like a bond, and you just plan to hold on to it and collect all the interest and principal payments you were promised. Now, you might be looking at that and thinking, wait a minute, why would anyone pay more than $1 million for a $1 million bond? Well, it's all about the interest rate. If that bond pays a higher interest rate than what the market is offering right now, investors are willing to pay a premium for it. That extra cost is then just gradually spread out, or amortized, over the bond's life, which keeps the accounting nice and stable. Path number 2 has a long name, fair value through profit or loss, or FVPL for short. You can just think of this as the trader's path. If you buy an asset mainly to sell it for a quick gain, then you have to update its value, or market to market, at every single reporting period. And any change, up or down, goes straight onto the income statement. This can make a company's earnings jump all over the place, which can sometimes spook investors who like to see steady results. And that brings us to our third path, fair value through other comprehensive income, FVOCI. This one's the hybrid. It's for when you're holding an asset to collect payments, but you might also sell it if the price is right. Here, the value changes are still tracked, but they get parked in a separate little corner of equity, so they don't cause all that volatility in the main profit number. So let's just boil this all down, shall we? Here's the big takeaway on our three paths. Amortized cost gives you stability. Fair value through profit or loss gives you the raw, real-time market picture, but it can be really volatile. And that middle path, FBOCI, it tries to give you the best of both worlds by smoothing out those big market swings.
Now let's take a quick detour and look at a special and really powerful use for financial instruments. See, sometimes companies don't buy them as an investment at all. They use them as a kind of financial insurance. This is called hedging.
And hedging is often done with something called a derivative. Now, don't let the word derivative intimidate you. All it means is that it's a contract whose value is derived from something else, like an exchange rate, the price of oil, or a stock market index. The logic behind a hedge is actually pretty brilliant and simple. First, a company sees a risk on the horizon. Let's say they have to pay a supplier in US dollars in 3 months. Second, they enter into a contract, the hedge, to lock in today's exchange rate. And third, if the exchange rate moves against them, the loss they make on their payment is perfectly offset by a gain they make on their contract. So, what's the bottom line here? Hedging is an incredibly powerful tool. It lets a business take a huge financial unknown, like a bouncing currency rate, and turn it into a known certainty. And that makes planning for the future a whole lot easier. Okay, we've made it to the final stop on our journey. We've been through all these complex decisions and different paths. And you have to ask yourself, why? Why bother with all this complexity? What's the real destination here? And this quote, which is based on the official accounting standards, really says it all. The whole point, the entire goal, is transparency. It's all about giving investors and lenders and really anyone who's interested a clear and consistent picture of a company's financial situation and the risks it's facing. And specifically, the rules force companies to be upfront about their exposure to these three major types of risk. Think about it. If you're going to invest your hard-earned money in a company, isn't this exactly the kind of stuff you'd want to know? It's the difference between making an informed decision and just gambling. So, this entire journey that we've just been on, it's all designed to create a consistent, understandable, level playing field for everyone. But in a world where finance is getting more and more complex every single day, it leaves us with one final big question to think about. Is a rule book, no matter how good it is, ever really enough?